There are moments in markets when prices move first and explanations arrive later. These are the moments when nothing is officially broken, yet everyone serious begins paying attention. Silver has entered one of those moments, not through headlines or confirmation, but through whispers. A rumor that refuses to fade, a pattern that refuses to look normal, and a silence from institutions that speaks louder than statements. This is not excitement or prediction. It is about what happens when confidence quietly weakens inside a system built on trust. Trust does not collapse with noise. It softens and hesitates. And by the time the noise becomes obvious, the time to prepare is already gone. They are welcome to the currency game. This channel exists for viewers who have seen cycles repeat, who understand that markets reward patience, and who prefer calm analysis over sudden reaction. The narrator gently asks, almost like speaking to a seasoned friend, to consider subscribing, not out of urgency, but because experience teaches that staying informed early is wiser than catching up later. The audience is also invited to share where they are watching from, because markets move globally and perspective matters. In financial history, the most important shifts rarely begin with certainty. They begin with discomfort. Markets do not move on facts alone. They move on belief, confidence, and shared expectations. When those expectations start to change, behavior adjusts before confirmation appears. This is why serious capital does not dismiss rumors. It studies them. A rumor, in professional terms, is unconfirmed information spreading faster than official validation. When such information circulates among experienced participants, it often signals that something beneath the surface is changing. Silver has a long history of behaving this way. Unlike many assets, silver exists simultaneously as physical metal and as paper representation. Physical silver must be mined, refined, stored, and delivered. Paper silver exists as contracts, obligations, and promises. As long as both are trusted equally, the system appears stable. When trust begins to shift, even slightly, balance becomes fragile. This is where rumors matter. When participants begin to question whether paper claims truly represent available metal, conversations change. Language becomes cautious. Assumptions are tested. And before prices move, positioning changes. History shows this pattern clearly. Before currency adjustments, there are quiet reallocations. Before banking stress, there are silent withdrawals. Before commodity disruptions, there are delivery discussions. Rarely does the warning arrive with certainty. The current silver rumor is not spreading because attention is scarce. It is spreading because the environment allows it to make sense. Inventories are examined more closely. Premiums receive renewed focus. Delivery timelines are discussed rather than assumed. These behaviors are not driven by emotion. They are driven by risk awareness. The business community understands a simple rule. Systems built on leverage depend more on confidence than supply. When confidence weakens, leverage becomes dangerous. Silver pricing relies heavily on leverage. A relatively small amount of physical metal supports a much larger volume of paper claims. This structure functions smoothly when delivery demand remains limited and predictable. The moment that assumption is questioned, stress appears. Importantly, the truth of the rumor is not the central issue. The reaction to the rumor is, when experienced participants adjust behavior before confirmation, it suggests that waiting carries greater risk than acting early. This is why institutional capital watches structure more than headlines. The structure of the silver market is global and interconnected. Paper markets in one region interact with physical demand in another. Pricing assumes smooth coordination between both. When coordination shows signs of friction, attention increases. Nothing has officially failed. No system has collapsed. No delivery default has been announced, yet the conversation has changed. And that change itself is the signal. Entrepreneurs recognize this pattern in operations and supply chains. Stress appears quietly before it becomes visible. Liquidity tightens before prices react. Confidence fades before disruption arrives. Silver is no different. The current rumor wave matters not because it promises a specific outcome, but because it reveals a shift in perception. Perception is always the first movement, and once it begins, it rarely stops quietly. To understand why the current rumor environment matters, one must first understand how silver is priced in the modern financial system. Most people assume prices move because metal is bought and sold. In reality, silver prices move mostly because contracts change hands. The global silver price is discovered primarily through paper markets. These markets trade futures, options, and derivatives. Each contract represents silver, but most of these contracts will never result in physical delivery. They are closed, rolled over, or offset long before metal is required. This system was designed for efficiency. It allows producers to hedge, consumers to plan, and investors to express views without handling physical metal. For decades, it worked smoothly because one assumption remained stable. Most participants did not want delivery. That assumption is the foundation. Paper-silver markets function on leverage. For every ounce of physical silver available for delivery, many more ounces are traded on paper. This is not hidden. It is structural. The system assumes that delivery requests will remain low and predictable. As long as that assumption holds, prices appear orderly. But leverage always comes with a condition. Confidence must remain intact. When confidence is high, paper contracts behave like silver itself. When confidence weakens, paper and physical begin to separate. This separation does not happen loudly. It happens through small signs. First, spreads widen. Then, delivery windows become important talking points. Then, inventory reports are read more carefully than usual. These are not coincidences. They are early stress indicators. Paper exchanges do not hold unlimited metal. They rely on warehouses, approved inventories, and the willingness of holders to make metal available when required. Most of the time, this is not tested because the system discourages delivery through fees, timing, and incentives. Delivery is possible, but it is not encouraged. This creates a fragile balance. If even a small percentage of participants decide they prefer metal instead of contracts, pressure increases quickly. The system can handle normal demand. It struggles with synchronized behavior. This is why rumors about producers, inventories, or delivery behavior carry weight. They challenge the assumption that supply will always flow into the paper system. Importantly, exchanges do not fail because metal disappears overnight. They fail because expectations change faster than mechanisms can adjust. A futures exchange is not a warehouse. It is a clearing system. Its job is to match buyers and sellers, manage risk, and maintain confidence. When confidence weakens, intervention becomes more visible. Volume limits, account restrictions, and rule enforcement are not routine events. They are signals that behavior has moved outside expected boundaries. Professional participants pay close attention to these moments. They ask simple questions. Why now? Why this behavior? Why this response? These questions matter more than headlines. Silver's uniqueness adds another layer. It is both an industrial metal and a monetary metal. This dual role creates competing demand forces. Industrial users need reliability. Investors seek protection. And when both groups become attentive at the same time, pressure increases. The paper system was not designed for sustained delivery demand from multiple directions. This does not mean collapse is inevitable. It means sensitivity is high. When sensitivity is high, small inputs create large reactions. This is why the current environment feels different. It is not defined by panic. It is defined by alertness. Participants are watching structure, not price. They are watching how exchanges communicate. They are watching how inventories behave. They are watching whether normal incentives still work. Most importantly, they are watching each other. Markets are social systems. Confidence is contagious. So is doubt. When doubt appears, it does not need to be loud to be effective. It only needs to be shared among those who matter. The silver market is not large compared to global capital flows. That makes it efficient during calm periods. It also makes it fragile during stress. Entrepreneurs understand fragile systems. They know that efficiency often removes redundancy. When redundancy is removed, resilience declines. The paper-silver system is efficient. It is not redundant. That is why perception matters so much. If participants believe delivery will remain easy, the system continues. If they believe delivery might become difficult, behavior changes before confirmation arrives. This is not speculation. It is risk management. The rumor spreading now does not need to be true to be powerful. It only needs to be plausible within the current structure. And for many watching closely, plausibility has increased. The next part examines why the broader economic and regulatory environment has made this moment especially sensitive, and why timing matters more than ever. Markets rarely break because of a single event. They break because pressure builds quietly, and then something small arrives at the wrong time. Timing turns ordinary stress into extraordinary outcomes. Silver is currently sitting in such a timing window. This moment is not defined by chaos. It is defined by compression. Multiple forces are pressing on the system at once, reducing its ability to absorb surprises. The first force is global liquidity. Across major economies, liquidity conditions have tightened. Credit is more selective. Financing costs are higher. Risk tolerance is lower. In such environments, leveraged systems become less forgiving. Positions that once felt safe begin to feel heavy. Paper-silver markets depend on leverage. When liquidity tightens, leverage becomes a liability rather than a tool. This changes behavior. Participants who previously rolled contracts without concern begin to reassess exposure. Margin sensitivity increases. Volatility matters more. Even stable markets start to feel unstable when liquidity thins. The second force is geographic divergence. Silver does not trade in one place. It trades across regions with different rules, priorities, and demand profiles. Western exchanges emphasize financial efficiency. Eastern markets emphasize physical settlement and industrial flow. When pricing behavior between these regions aligns, stress is low. When it diverges, arbitrage becomes difficult and trust weakens. Recently, attention is focused on unusual behavior in Asian silver venues, not because prices moved dramatically, but because how they moved drew scrutiny. When exchanges publicly acknowledge abnormal activity, it signals more than enforcement. It signals that behavior exceeded expectations. This matters because exchanges prefer stability. Public action suggests private concern. Restrictions, volume limits, and rule enforcement are not routine adjustments. They are responses to crowding, leverage concentration, or attempts to force outcomes. Professional capital understands this language. It reads exchange actions as signals, not punishments. The third force is physical sensitivity. Physical silver markets operate on timelines. Refining takes time. Shipping takes time. Inventory is not instantly flexible. When demand increases unexpectedly, the system responds slowly. In calm conditions, this lag is invisible. In stressed conditions, it becomes important. Premiums begin to reflect urgency. Delivery windows become negotiation points. Availability becomes regional rather than global. This does not mean metal disappears. It means metal becomes selective. Selectivity is a warning sign. Industrial users cannot pause production easily. They require reliability. When reliability feels uncertain, they secure supply early. This behavior removes flexibility from the system. At the same time, investors watch these developments closely. They do not need shortages to act. They act on risk of constraint. This creates feedback. The fourth force is information velocity. Modern markets process information faster than ever, but not all information moves publicly. Professional networks share observations quietly. Positioning adjusts silently. By the time narratives reach mainstream awareness, adjustments are already made. Rumors thrive in such environments because they fill informational gaps. They explain observed behavior before official explanations arrive. When behavior changes first, stories follow. The current silver rumor is a response to observed anomalies, not a random idea. It attempts to explain why certain actions no longer look normal. This is why it spreads. The fifth force is psychological asymmetry. In highly leveraged systems, upside and downside are not symmetric. A small loss of confidence can cause disproportionate reactions. This makes rational actors cautious. When downside risk grows faster than upside potential, behavior becomes defensive. This does not look like panic. It looks like restraint. Restraint shows up as reduced exposure, as preference for certainty, as reluctance to rely on promises. Silver, as a market, is sensitive to restraint because its paper structure assumes participation. When participation becomes selective, liquidity thins further. Timing matters here because none of these forces alone would be destabilizing. Together, they compress tolerance. Compressed systems react faster. Entrepreneurs understand this from operations. When supply chains run lean, small disruptions cause delays. When margins are thin, small cost increases hurt. Silver is operating with thin margins of confidence. This does not predict a specific outcome. It identifies a fragile moment. Fragility is not failure. It is vulnerability, and vulnerability attracts attention. The next part explores how sophisticated capital responds in such moments, not with headlines or declarations, but with quiet strategic adjustments that often go unnoticed until they are complete. When markets enter a fragile phase, the most important activity happens quietly. There are no announcements, no dramatic exits, no public declarations of concern. Instead, experienced capital adjusts in ways that are almost invisible to the casual observer. This phase is known as silent positioning. Serious participants do not wait for confirmation. Confirmation usually arrives after risk has already materialized. They also do not act on emotion. They act on probability, structure, and consequence. In moments like the current one in silver, their first question is not, is the rumor true? Their question is, what happens if it is partly true? This way of thinking changes everything. In leveraged systems, outcomes are not linear. A small change in behavior can produce a large effect. If a few participants decide to reduce reliance on paper claims, the impact can be greater than the size of their action. This is why early responses focus on optionality. Optionality means flexibility. It means the ability to respond if conditions change. Capital seeks positions that do not force immediate decisions later. This often looks like rebalancing rather than exiting. Exposure is adjusted, not eliminated. Risk is redistributed, not advertised. Dependency on single assumptions is reduced. In the silver context, this can mean preferring structures that are less sensitive to delivery risk. It can mean shortening timelines. It can mean avoiding crowded trades. None of this shows up clearly in price at first. Price is often the last indicator. Before price moves, liquidity changes, depth thins, volatility becomes uneven, certain trades stop working the way they used to. Professional participants notice this. They also pay attention to who stops participating. When reliable counterparties become selective, it changes the ecosystem. Markets function best when participants are predictable. When predictability declines, risk rises. Entrepreneurs recognize this pattern in business. When suppliers ask more questions than usual, something is changing. When terms become stricter, conditions are tightening. When flexibility disappears, pressure is building. Silver markets are no different. At this stage, capital does not seek to be right. It seeks to avoid being wrong in a large way. This is an important distinction. Waiting for certainty often means accepting higher cost. Acting early means accepting uncertainty but controlling exposure. This is why silent positioning happens before public narratives solidify. Another key behavior during this phase is observation. Serious capital watches how institutions communicate. Language matters. Tone matters. What is said matters less than what is avoided. When exchanges, regulators, or large participants become careful with wording, it signals sensitivity. This does not mean panic, it means awareness. Awareness spreads quietly. At the same time, second-order thinking becomes dominant. Participants stop focusing on silver alone. They consider what silver stress might signal about broader systems. Silver sits at the intersection of finance and industry. Stress here can reflect deeper issues, liquidity constraints, trust in settlement systems, or shifts in global trade behavior. For business leaders and entrepreneurs, these signals matter even if they never touch silver directly. Commodity stress often precedes changes in financing conditions. It can affect costs, availability, and planning horizons. This is why strategic observers treat silver not as a trade, but as an indicator. Indicators do not tell you what will happen. They tell you where to look. At this stage, preparation becomes more valuable than prediction. Preparation means understanding dependencies. It means identifying where assumptions exist. It means asking which parts of one's own operations rely on uninterrupted systems. The danger in moments like this is not loss, it is surprise. Surprise happens when systems assume to be stable change faster than expected. Experienced capital works to remove surprise. This is done quietly, patiently, and often invisibly. By the time outcomes become obvious, positioning is complete. The crowd reacts, headlines follow, explanations are written. But the real decisions were made earlier, during the uncomfortable phase when nothing was confirmed and everything felt slightly off. This is where the current silver environment sits. Not in crisis, not in resolution, but in transition. Transitions reward those who pay attention early and punish those who wait for clarity. The lesson is not about silver alone. It is about how systems behave when confidence becomes conditional. For those willing to observe rather than react, these moments offer the most valuable information of all. Not answers, but warnings.